I'm curious, what do you have like a specific process that you use when you go through your spin-off investing?
Yes, so I'm trying to, I think I run the site stockspinoffinvesting.com, and
Yep.
so that site is I try to cherry pick the most promising spinoffs. But what I'm trying to morph into is to basically cover every spinoff. So the nice thing about spinoffs is that the Form 10s are filed, maybe a year in advance, at least 3 months in advance of when they start trading. So you can do your work ahead of time and really be prepared for when the stock starts trading. For whether, to potentially buy it if you think it looks interesting. But I mean, my process in an ideal world, and it's not, there are a lot of spinoffs, so it's, not that I follow this to a T every single time, but in an ideal world, first of all, I'm looking for a spinoff where it looks like there could be some indiscriminate selling. For instance, Contour Brands is a spinoff that's going to be happening by the end of May. We're in 2019. I don't know when this video will go live, but the parent company, VF Corp, is a 30 billion plus cap company that has premier brands like the North Face and Vans and Timberland and other brands that are very attractive and growing well. And then this other spinoff is going to be, by my math, it might be kind of a 2 billion or 3 billion market cap company. And it's with the Wrangler and Lee brands, which aren't as attractive, aren't growing as well, but they seem pretty stable. It seems like, the business generates a good amount of cash flow. And then VF Corp is in the S&P 500, so it's owned by a bunch of index funds. Meanwhile, Contour Brands will not be owned by those index funds. A lot of times, a lot of the people who own VF Corp will be focused on large cap stocks because it's a 30 billion market cap company. And then Contour Brands is going to be, under a 5 billion market cap company for sure. And so I'm looking for situations like that. So that's one where I'm excited to dig in. And then my process is we'll listen to the earnings calls. We'll read, any other analysis that's been published on Seeking Alpha or any other brokerage reports that I can get my hands on to get, up to speed on the company. Then I will read the Form 10 and, basically I'm just trying to look at the financials, look at the trends. Does the business make money? Has revenue been growing? What's the margin profile? Is this a hot company, or is it like a bad company that, the parent company wants to get rid of so that it improve its growth profile? Of course, I'm looking at the capital structure, seeing how much debt is going to be on the business. I'm looking, one thing that I look for is how did the business perform in the last recession? Sometimes you can see that, sometimes you can't, because the division, there would have been a number of acquisitions and divestitures since the last recession, so you can't quite tell apples to apples how it did during the last recession, but usually you can get a pretty good clue. And then I'm also looking for comparable companies. So, if you just search for competition in the Form 10, it'll usually identify the publicly traded companies. Not always, but oftentimes it will. And so you can use that as your starting point for seeing, okay, what are the competitors to this company trade at? On an EV to EBITDA basis, on a price to earnings basis. And then you can kind of back into or work through what you think is a fair enterprise value and market cap for a company. And then, so that's the fun part. I mean, the fun part is that you get to do all this work, and it's really interesting because you're not biased by the market, because there's no market cap, there's no stock. So I think it's a really good exercise in terms of learning how to value a stock, because you're forced to do independent work because you're not biased by what the current price is or what the current market cap is. And then, you do your work, and then you see basically where it starts trading, and sometimes it'll be a business that is interesting that you'll actually want to own. There's some businesses that maybe you just can't understand, or it's really hard to value. But if I get a situation where it's a stock that I'm like, okay, yeah, I'd want to own this at the right price, and then it just gets sold like indiscriminately for no reason, then that's super interesting. So that's kind of the ideal situation that I'm looking for. But in terms of kind of the prep time or the key things that I look for ahead of time, it's just, doing kind of normal things that anybody would do, looking at a company, looking at the financial trends, Try to talk to the company's investor relations department if you can. Get a sense for how resilient the business is. Do they generate real cash? Do they not? How are incentives? Greenblatt mentions a lot about incentives. Is the management team incentivized to grow the business? Are they going to have skin in the game? And so what you can search for is executive compensation, and every spinoff will tell you how many shares are reserved for executive compensation. And so, that's something that I always look for. It's usually around 10% if it's a small cap company, or if it's a bigger company, it'll at least be a couple $100 million of shares. So usually management's pretty incentivized to make the stock or to make the spinoff do well. But those are kind of, some of the things that I look for when I'm evaluating a spinoff ahead of time.
Yeah. Hey, I appreciate you talking about Contour Brands. I'm going to go off topic here for a minute because I was looking at the Form 10 just recently as well, and I saw it and I was like, oh, well, this is interesting. And then I saw the two brands, Lee and Wrangler, and my wife, she's like, that's the one thing that she loves on a man is a Wrangler butt,
Really?
And so it's just like, you think about like what Charlie Munger says about spinoffs. He says, yeah, we want to go ahead and get into something that's one way to get into a good portfolio. And he says, you know what? What about getting into a brand that somebody might like, has those long-term intrinsic value?
You're right.
Pretty interesting to see. So anyway.
Yeah, no, and that one, it seems like the other interesting thing about that one is it's jeans. They've been around since the gold rush. Jeans, the style ebbs and flows. They're not, sometimes they're popular, sometimes they're not. But I think, in 50 years, people are still going to be wearing jeans. And Lee and Wrangler, those brands are going to be around. I mean, sales have been declining over the past 3 years. So, they gotta go direct to the consumer or change it up and try to turn the ship around. But that's a business. Not that I would want to own it at any price, but like if it got cheap enough, I think that one would be interesting because it's super easy to understand. So I agree that's an interesting one to look at.
Let's look at another one for a second. I've been watching Garrett quite a bit, and I've loved that thing.
Yeah,
it's done pretty well.
Did you own it?
I got into it at 16, and then when it dropped back in December, I started selling puts on it, and I bought into it again at $12.50. So I'm about $14.50 into it right now, and then
that's great.
If the puts expire without any cost on it, it'll probably put me down into the low 10s. And so in that case, I might just hold it for the long term and just kind of ride it out for a little while. So but anyway, that one was kind of the same thing where it was you think about your Honeywell was this huge Dow Jones type investment, and then there's a tiny little spinoff on the side. So
totally, yeah. So that one, I literally was working on my investment case when it was around in December when it was around 13 and then 12 and then it got below 12. And I was working on my investment case and, basically writing it up and the stock started to rally. And I was like, okay, no rush to publish this thing, wait for it to come back down. And then it's like it bounced around at 11 and 12 for a while. And then it's been a pretty steady ride up since December. I mean, it's been impressive. And so the thing that when I initially looked at it, I thought, okay, turbochargers, electric cars, the world's going electric. We don't need electric cars don't need turbochargers. But, the thing that I, came to appreciate is that there's a bunch of hybrids that are going to be coming on the market, which actually do require turbochargers. Meanwhile, the internal combustion engine cars, there's the secular, tailwind where to be more energy efficient, it helps to have a turbocharger. So you have those tailwinds and the business generates a ton of cash, as I think, it's a pretty high quality business. They don't have very significant capital expenditures. So that one was one that took me a while to get comfortable with. And then before I kind of bitten the bullet. It started to move on me. So that's one that, but it's an ideal setup. It's people that own Honeywell really own it for aerospace exposure, the secular tailwinds there, and they don't own it for the turbocharger business. And so it was like an ideal setup, and you did see that indiscriminate selling. And I wish I could have taken advantage of it, but I won't miss the next one.
Well, it's I think it's the nature of this business where you're just like, well, maybe I'll catch it, maybe I won't,
Exactly.
I had the same thing happen to me when I was writing that book about spinoffs with CEIX.
Mm-hmm.
Like I should have bought it at the moment, because I even had it valued exactly where it was a month later.
Yeah.
It's painful to see that, but it's kind of like, a fisherman. We always talk about the one that gets away,
Exactly right.